Started. All right, everybody, welcome back on Closing Bell. This is Dallas Puglisi from Cyber Trade University. We do this every Tuesday at 4:30 Eastern Standard Time, where we bring one of our channel partners in to come and talk about and educate all of you about the markets. And today's featured guest is an old friend of mine, known for many, many years. I mean, I probably know Price over 10 years now. Been in the industry for a very, very long time, as long as I have. It's amazing where time goes. But Price is very well known in the industry, in big trends. Today's topic that he's going to be talking about is how to spot quick trades with option charts. And once again, Price is going to be talking for about an hour about options and basically how to read the charts a little bit more in detail, which he's a real big expert on. And that's the beauty about why we bring us speakers in here to do presentations. And also, one of the things I want to know about his charts more than anything, because Price Healy is from Kentucky, and we all probably know that the Kentucky Derby is this weekend. I was supposed to be there. Price probably wasn't expecting me to say that, but I know he has a chart that's specifically designed for all 21 horses and lets you know how the MACD is going to follow and who's going to win the race on top of it as option. So looking forward to looking at that. In the meantime, everyone, enjoy the presentation. Everyone, like I said, he's going to talk about an hour, and he will be closing out the meeting. Price, the stage is all yours.
Well, thank you, Fausto, and great to be with everybody here. And Fausto, very perceptive that the first Saturday in May is indeed the Kentucky Derby coming up here in my home state, in beautiful rolling hills of Kentucky, and we're excited about the Derby coming up. I don't know if I've got a MACD chart for that one, Fausto, but we do actually. I have some pics that I'll put up on the bigtrends.com website there come Friday morning, so everybody should check that out with my compliments of what I'm forecasting. But again, I would say that's a lot less certain than the trades that we can make in the markets. As Fausto said, I'm excited to be with you to share with you today my favorite tools as it relates to not just stock trading, but then moving over into options trading. And so, we're going to kind of merge a couple of concepts here. Option charts along with high dollar stocks. When you think about Apple, you think about Google. I'm just curious, by the way, how many of you trade Apple or have a position in Apple, for example? I always have a lot of people asking me about that, or people that are interested in trading a stock like Apple, but just think it's too high priced. Okay, so a few of you say no, that basically you're probably worried that the stock's back towards $600 a share. Big positive earnings surprise from the low 500s, now pushing 600 when the market was correcting the last couple of sessions. Apple kept chugging to the upside. So, occasionally some of you do spread trades. We'll talk about, hey, you don't have to own it for the long haul, but you can get a piece of some of these high dollar stocks with weekly options. And then I'm going to share with you how to spot those quick trades with option charts. We're going to kind of merge those two concepts today. Of course, I want to remind everybody here that everything that we share with you across this presentation is geared for your information and education only. Nothing should be construed as a specific buy or sell recommendation that I share with you today. Although I do that for my weekly Options Accelerator clients, and I'll give you actually a special web link to actually get you started on a 1-month lowest price entry point I've ever done, so you can start to participate in that service here at the end of the presentation. Ultimately, you know that when it comes down to it, you are solely responsible for your investment decisions. And here at Big Trends, we seek to be a resource. We're like Fausto and really believe in the power of education. The education can help you make better decisions. But obviously, all trades involve risk. So make sure you factor that in and consult with your tax and financial advisor on any investment that you might make that might impact your unique financial and tax situation. So, today we're going to talk about these concepts tied in with my favorite options trading vehicle, and that is weekly options. When we talk about weeklies, we're talking about options here that are really focused on, the least amount of time possible that you don't have to pay a lot of premium for with the weeklies, but as a result, you can kind of bracket the markets for a period of anywhere from a day to a week or so. That we're usually not day traders per se. I know Fausto does a lot of very quick trades as well. We can take profits quickly in a day if we get our profit targets, but at the same time, we have the ability to swing trade over a period of a couple of days up to a week as well. So, but the weekly options, the whole concept is, why would you want to buy more time than you really need, especially if you're leveraging some of these higher dollar stocks. So why do I love weeklies on high dollar stocks? We're going to talk about that today. To me, it's really my favorite vehicle out here, weeklies on high dollar stocks, because the idea is, why would you buy 100 shares of stock and say $600 a share? It's going to cost you 60 grand when you can control that same stock for anywhere between, definitely under $1,000 and sometimes as low as maybe $500 on a 60,000. That's a leverage potential of up to 100 to 1. Now, we don't have to go for absolute maximum leverage. In fact, a big part of what I teach at Big Trends is make sure you buy the right option. So when we're looking at our option charts here, we're talking about, okay, make sure that your chart is not working just on the stock, but also that it's working on the option. So we want to make sure we're trading the right option here. So I see a lot of traders who get greedy. You've never gotten greedy in your trading, have you? Everybody's probably been there at one time or another where they thought, man, this is easy. I should have quit my regular job a long time ago, right? Well, that's a warning sign if you start thinking like that, maybe the markets are due to give you a little bit of a lesson in humility, right? We want to stay very focused, very even. I never want to get too high in a good phase or too low when I get a couple of stop outs in a row. The idea is that you've got to focus on staying consistent. And we're going to talk about, obviously, we're now right into the end of April, so we're about a third of the way through 2014, and I do want to share my outlook with you about where I think the markets are headed before we're done. Now, I promise you we're going to talk about option charts. We'll jump right into that first. What's the whole point of an option chart? What am I talking about when I talk about this concept of an option chart? I'm talking about the actual plotting of the prices of that option that traded on that underlying stock or market as we go throughout the day, intraday, and every day. And so the idea is that, okay, isn't that, I had even an options guru, a well-known one that you would know, tell me, isn't that what's the point? You're just looking at a derivative on the stock. Why would you bother to look at an options chart? And frankly, I've been talking about this concept now for a number of years, and that still most people are still trying to essentially guess whether they should buy an option or sell an option or do nothing. And I believe that if you look at the option chart, it gives you a couple of distinct advantages to confirm or not confirm what you're seeing in the stock. We all know that options are time-limited assets, right? So the basic premise here is that we're focused on the idea that, okay, if you buy a stock like Apple, IBM, Microsoft, Google, those companies are probably going to be around for many, many decades. Obviously, there's no guarantees, but the idea is that they'll probably be around a long, long time. And that's why a lot of people say, well, then buy the stock and hold it forever. But the leverage potential happens with an option because, of course, you're buying an option to own that stock, to buy it, or potentially a put option is a right to sell that stock at a set price. And the idea is that, okay, we can essentially lease that stock's movement for a period of time instead of having to get locked up on buying the whole 60 grand on the stock. We can lease that for 500 to 1,000 bucks. I'll never actually buy an option over 1,000 bucks for my weekly options accelerator clients, because I find that that's a point where a lot of people feel like it starts to get a little too pricey past that for an option contract. And so we can still buy the right kind of option. Now, this is what I want to talk about. You know that if you buy, and of course the other factor is volatility. Volatility, when you're buying an option, say right in front of earnings, that's going to be juiced up on that option price, right? Because there's a volatility that's expected from that earnings when that earnings hits. In comparison, of course, once the earnings actually comes out, the volatility collapses, or what we call volatility implodes, as you get the event behind you. So, you want to be careful about making sure you don't buy an option that then you see the volatility implode unless you think that stock's really going to make a big move. Okay, so with that in mind, we say, look, if the stock stays flat, if you buy the wrong type of option, and my definition for this short-term strategy is if most people like to buy an at-the-money, which is called an ATM option, at the money or near the money, you may hear it called at times, or an out-of-the-money option, which we call OTM, out of the money, meaning that if you buy a stock's at 100, if you buy a 100 strike call, that's considered at the money. If you bought the 105 call, that's considered 5 points out of the money. I think that's a mistake to buy those options, because if the stock doesn't move, your option's going to expire and you lose, because that time erosion really hits the option. You see it especially on the option charts. So what I focus on instead is the in-the-money options, what we call the ITM options, okay? So the basic premise here is that, and if the stock's at 100, if I buy the 95 calls, that's a right to buy the stock at 95. Well, why wouldn't I go ahead and exercise that right? And I'll tell you why. But, if I exercise that right now, then I could buy the stock at 95, sell it in the open market at the current price of $100 and pocket that 5-point difference. So in this example, let's say you got the stock at 100, and then you say, okay, it's $100 per share, and you compare that to say the 95 call that we're talking about here, and say that's trading at say $7. Okay, so what that means is that we just told you that 5 of that 7 is what we call in the money or intrinsic value. Okay, so essentially you're saying, look, if I say 5 of those 7 points are intrinsic value, even if this stock doesn't move, even if you get stuck in a choppy market, a situation where, there's a variety of factors, of course, that can influence the stock's price. It's not just what's going on with that company, as you know. It's also what's going on with the market. We're going to talk about the market here as well. But still, you're saying, look, that's basically saying, look, 71% of that option is intrinsic value there. So that's 71% in the money, okay? And the other 2 sevenths is what we call time value. Some people call it extrinsic value. It's sort of the opposite of intrinsic value. I just like to call it time value, which in this case means that you've got 29% time. So that the idea of that is that if nothing happens, essentially, at the expiration, that option, the 95 call, is still worth $5, and you've lost 29% if the stock didn't move at all. Obviously, you wouldn't want to buy an option if you thought the stock was going to stay flat. That's where the option sellers would be interested. So, in an example like this, you're saying, look, say the stock goes from, say, 100 and it goes to, say, 101, right? So you're up 1% on the stock, and you say, okay, for that same move, the 95 call should go from 7.00, and let's just say that we say it's trading with a delta of 70%, meaning that on a 1-point move up in the stock, the option should go up about 70% of that, or 7.70 being the value. In this case, it would be plus 10%. So there you'd be talking about a leverage ratio of about 10 to 1 of the in-the-money option compared to the stock. Now, sure, an at-the-money or out-of-the-money option at times might have even greater leverage, but remember, leverage is a double-edged sword. And so if you look at a situation here in which you're saying, hey, if we're talking about leverage on the upside, but then also having leverage on the downside, that's an issue. We want to sort of make sure we can get the benefit of the positive leverage helping us, but also minimize the impact when leverage is not helping us. And the third scenario, besides the up and the down, as you know, is sideways. And so the in-the-money strategy does a much better job, in my experience, of managing a sideways trade so that you don't get crushed, but rather can control that risk. It's kind of like the time decay is the idea of saying it's like holding an ice cube in your hand, and if you turn up the heat in the room, especially, that basically you're going to see that ice cube melting faster. And so that's where, you want to avoid that type of a situation here. So let's go now to the next screen here. Are Morris and Ronald saying you're just ready to change it up here? So yeah, let's look at an example. I want to lay some groundwork here for you first in the PowerPoints and in the philosophy, so that then we can, I'm more focused on kind of a few key concepts here and really trying to hammer those points home than jumping through, 100 different slides, in a tight time frame. I'd rather you get a few key concepts right, and then you can build on that. So, for example, in a past example here with Goldman Sachs, this is a triple time frame pattern that I look for on my weekly options buying that I do. We do a variety of strategies, but here for buying an in-the-money option, we start with the big picture on the right. That's the Goldman Sachs daily chart. And we've got a variety of things that I like to look at from, like Fausto said, he's been trading as long as I have, 25 years now. We're talking about when the market's starting to break out here. You see how we're getting into this overbought mode for a tool like %R here on the right side of the chart. That's when that market goes overbought there using a tool like the Williams %R indicator. That means percent range. A lot of people assume that move is done. Overbought is bad, right? No, not necessarily. If that stock or market keeps wanting to go up, you can see in this case it started to fall through a couple of days after that first overbought point to give us our first daily chart buy signal. Then we're saying, okay, that's an example where the market's ready to go to the upside. That was happening when everybody's wringing their hands about the quote-unquote fiscal cliff. And we're saying, okay, look, as we started off that hourly chart in the middle panel here, you can see we're looking at the same concept happening. We're breaking out on the hourly. As we start to go overbought and then we keep going up, we're getting our buy signal. These charts are created from TradeStation, but you can use a lot of different platforms to plot this. I will show you my live setups here in just in a few minutes after we go through the fundamental principles here. Even the 15-minute chart on the very left side of the page was pointing out this is usually good for more of a quick trade setup here. If you're talking about the 15-minute chart and saying, look, it's just starting to go right in here, starting to go overbought, starting to break out just above that high. And then it cruises on up. You can see in that nice steady up channel the rest of that session. So if you're only day trading and you're out there at the end of the day, you're still real happy as the stock went from 131 to 134. Doesn't sound like much, right? 3 points, a little over a couple percent in the stock. But that, as we go now, look at our next example, and we'll talk about what some of these other indicators mean too. This is the Jan 125 calls. The stock was at 131 when we made that recommendation. And so you know right away, if you're buying a Jan 125 call, you're looking at a $6 in the money situation already. You say, gee, isn't that going to be very expensive? We're paying up to $7.50 for it. Do some quick math. $1.50 of time left over and above that $6 of intrinsic means $1.50 out of $7.50 is only 20% of the option being time value. That gives you some incredible cushion, if you will, if you get stuck in a little bit of a choppy market. If it doesn't move immediately, but the pattern is still good, you don't get flushed out of the trade like you might in an at the money or out of the money type of a trade. So, so from this perspective, you see we get our buy signal kicking in there. It's just starting to surge that morning of the 4th here, and you can see it's running from about $7.50 on up to about $10. About a 3% gain in that first day's move. So again, we probably could have made more money if we bought the at the money option in that case, but we would have taken on much more risk. If you think of it this way, if you've got 100% time risk in an at the money option, and let's just say a 1/3 risk in the money option, then you're basically taking on 3 times the risk if you get into a flat scenario where the at the money option could get wiped out. So if you're taking on 3 times the risk, you better be getting 3 times the reward to make that trade worthy from a risk-adjusted basis. Most of the time, I don't see that really giving us that kind of an opportunity. So we would say, okay, it's better in this case to just go ahead and say, let's focus on the in-the-money strategy. For those that know options, one little guideline is that usually we're looking for a delta, as I said before, of about 2/3, about 67% or higher, meaning that stock goes up a point, we should get about 2/3 of that point move in our option. And that'll usually show you a leverage ratio somewhere in the neighborhood of about 10-to-1, and then growing as that thing moves in our favor. You see it settle for another day or two, kind of sideways to slightly lower on the 15-minute chart. But notice we're looking at percent R in this chart, but we also have a variety of other tools. We looked at the ADX and DMI lines down the bottom couple of panels. But then also the CCI is the Commodity Channel Index, that yellow line. And when that thing's staying in that, you can see in this hourly chart how it stays overbought and has a couple of what we call retests, where it just comes underneath this overbought threshold and comes down to retest. Those retests are oftentimes great points where it needs to hold, and if it doesn't, you can hop out. If it does, you can see it rocket fairly quickly up off of there. Goldman on that particular move actually ended up going in a lot higher over the next couple of months. So we don't have to catch all of a move to be very happy with it. So a past example here with our weekly options accelerator, which is our alert service that we call out specific real-time trades for our weekly options trader clients. I call it read it to your broker instruction. So if I'm getting in, we'll say buy to open. This is BTO, means buy to open. If you're new to options, you're opening the contract up and you're buying it to open. You theoretically could sell a contract to open if you wanted to be an option seller. We tend to focus here on this strategy of just buying and then leveraging the move. I call it creating a stock substitute. So from this perspective, when you're creating a stock substitute, you'll find that it's a lot easier. Now, let's just look at an example here as well. So when we did the Chipotle trade, CMG shares were at $321, okay? So you can quickly do some math with me to say, you know, it's not hard math, so don't worry. We're saying, look, if we're buying the 315 calls and the stock is at 321, you know, again, you got $6 intrinsic value. Here again, we're paying only up to $7.50. So you're always going to have to pay some amount of time. But the idea is that, you know, if you can minimize the amount of time you have to buy, yes, you're going to pay more in total dollars for this option than you would for the at the money or the out of the money. But as I said before, the risk of an in the money trade that you buy on a percentage basis is definitely lower than at the money or out of the money risk. If nothing happens, those other options could get crushed. You can control your risk here. In this case, it doesn't move at all. It stays at 321. This was the week 2 option that expired March 8th. You'd say, okay, well then if it finishes at March 8th, right at 321, I'm still worth $6. People say, yeah, but what if it goes against me? We'll talk about that scenario too, about how you stop out trades that aren't working. But you can see this is actually 2 different alerts I've merged together just to give you a taste. The bottom half of the separate alert. But then we said, okay, we're getting out of that trade. Got in at 750, got out of part of it, up about 50%, got out of the rest when it hit a double at $15. So, you know, part of what you have to understand here is, you know, a double on a 15, it sounds like a lot for the option to go to $15 from 7.5. It's not a lot comparatively in percentage terms. What can somebody tell me here, quick quiz, what intrinsically would CMG shares have to be trading at if you own the 315 call to make that option worth $15? Just pure intrinsic value, assuming all time was gone. Somebody have that quick calculation? Pretty simple math. There you go, Bar. It's 330. Michael as well, 330. That's right. So at 330, from the current price at 321, how much of a gain do you really need in order to see that option double at 330? Well, that's about a 3% move, right? So basically, yes, 3% from 321 to 330 has moved up 9 points, just under 3%. So you can do easy math, right? 100% on the option, under 3% on the stock, 33 to 1 or more leverage in that particular situation. So you don't have to get monstrous stock moves to make some really significant leverage in these options. And then, yes, we must control the times where it's not working. So we're going to talk about that too. I don't just want to talk about winning examples. I also want to talk about losing trades and how to manage both and control risk. We will typically start our stop on an in-the-money option at minus 30%. Since we're targeting 50 to up to 100%, if we can make 2 to 3 to 1 on our money, we feel really good about that. Okay, you don't have to be winning all the time in order to make money with the weekly options program when you're hitting, say, 2 to 1 size of winner versus size of loser. You know, if I told you were making $500 on a trade and then you're losing $250, making $500, losing $250. Sure, you know, you're not going to be the next Bill Gates tomorrow, but the idea is you're going to be certainly, you know, putting money in your pocket over time. That's the goal. So then it's all about controlling risk. The mistake a lot of traders make with weeklies or with any kind of options is they just sort of hang on and hope. We call it get into hopium mode. You don't want to have that trading drug called hopium, because basically that will cause you to freeze up and just hope that it'll come back. That's where you basically are not proactive and you're just now in a, well, gee, you know, hope that the market comes back. That's very, very damaging, not just to your portfolio over time, but also to your psychology. I want you to be in control of your trading destiny. You know, so you know that every trade involves risk, but we can really manage that appropriately. Now, Salim says you're buying the weeklies, not selling them. That's exactly correct. We're not trying to get too cute here. We're really trying to keep it simple. I find sometimes when traders get too cute and do multi-legged spreads, they end up messing up what otherwise might have been an okay trade because they try to do too many different things. Now, it used to be that on the final week of the monthly options life, the third week of the expiration used to be the only week that I could do this strategy years ago. And I did it often where I trade these options with only days to go before expiration. And if you've ever been to a basic options seminar from the options exchanges or anybody else, they'll probably tell you, because they're trying to just simplify and keep you out of trouble. They'll probably tell you don't trade any option that's got less than 30 days of life left. You should buy more time. They're trying to save you from making mistakes if you don't know what you're doing. And obviously that's a good strategy in the general goal, but what I found is that actually it's bad information when you focus on the right kind of approach to swing trade. I know a lot of you day trade or swing trade that, we focus on, okay, how can we, in essence, create a stock-like position and control that stock for a period of a day to maybe 5 trading days maximum. Usually we're in and out in 2 or 3 trading days. But the beauty is now every Thursday, they're listing weekly options to expire the following Friday. So like on this second Thursday, they don't relist those because they're already out there on the monthlies and starting to trade like weeklies. But every other Thursday, they're basically relisting a whole new set of options to expire the next Friday. So now every Friday becomes an expiration Friday. So you get an opportunity here to say, okay, there's a variety of strategies you can take advantage of, but here we're just talking about the simplest one, which is just buying a weekly option when the timing is right. This gives us an opportunity to trade around key events. The Fed's meeting right now. I'm going to, conclude their meeting tomorrow. Not expected to do anything new, but obviously people are always parsing any kind of Fed statements and comments. And of course, anything related to a reaction to earnings, a reaction to, we've got a jobs data report coming out this Friday before the open. So all these things are important to be aware of and then say, okay, what's the catalyst for potential movement? Not just in a stock, but also in the big ETFs and big major market indexes. So, we look here, for example, at, some of the names that we like to trade. And these are not the only names we'll trade, but I mentioned Apple earlier. I mentioned how, of course, Apple's one that, when it's rolling, we'll look at the chart in current pricing here before we're done. When it's rolling, we want to get a piece of that action, and again, it doesn't take much to get a really good pop. Of course, you know about Google, and now Google split. There's actually a couple different symbols we watch, GOOD and GOODL there for Google. You know about Netflix, about Priceline, about Amazon. A lot of these big cap NASDAQ stocks have been getting just absolutely taken to the shed and getting popped on the downside. I'd even add in a couple others here that we've been trading more regularly recently. We didn't trade Twitter right in front of its earnings today, which, so far looks like it was getting a little bit of a negative reaction there after the earnings. But a name like Twitter, of course, a name like a Facebook, a variety of these other symbols. So there's really a lot of different weekly options, but we'll focus on a couple of those today as well. Now, from the program that I've set up for my subscribers to get these real-time email, and now also we send it out as text alerts. It's called Weekly Options Accelerator. And every day we're putting out updates. Whether I do a trade or not every day, I'm going to always update my subscribers on exactly what I'm thinking. The first big rule of thumb is you've got to have a catalyst, whether it's an earnings reaction, whether it's a volume surge, some kind of a breakout or breakdown. There's got to be some driver that's causing that stock and thus the options to really move. We're going to look at a variety of option charts here as I share my screen with you in just a little bit. But basically, as I said before, laying some important groundwork here. We want to buy those options in the money. A fairly high delta, usually about 67% or higher, sometimes 70 and even 80%, you're getting close to an expiration, gives you more of what we call a stock substitute or stock surrogate type of a position. So that means that you can control that stock for a limited time, and then essentially you can focus on getting your timing right. It's all about timing in life, isn't trading, right? So it's important to do that. We used to keep our stop loss at minus 33. Now we've tightened it to minus 30. Doesn't sound like much, but every bit counts. You say, why not minus 10? Well, because sometimes the way these volatile stocks move, you might get noised out of a trade in an option if you're too tight on your stop. We found that once it gets past about minus 25 to minus 30, that's where it starts to really go against that position. But sometimes you can get that kind of swing noise in there, especially getting a position started in an option trade. And my solution, if that sounds like it's too much to you, is start small in the trades that you do. You don't have to trade tons of contracts to get great benefit from options. Even if you're only trading one contract at a time, it can be something that you find, some of those 50 and occasional 100%ers, those can help you, grow your portfolio fairly quickly when we're hitting on those fronts. And then, of course, if we're not, we're going to control the risk and move on to the next one. I never want to double down. I never want to average down my cost. Those kind of trades are amateur mistakes that a lot of newer traders make because they don't want to admit that they're wrong. Frankly, admitting you're wrong and following a discipline like we follow with our what we call progressive trailing stops is really critical. I'm going to show you some examples of that here in just a minute. Now, if you do get the windfall gap, if you got the gap on earnings or if you got some other surprise news that gapped in your favor, we like to book some of those profits into a meaningful gap just because we don't want to be greedy. We want to take money off the table as the market makes money available to us, but we don't want to overreact and take it all off the table. And we also don't want to, potentially sell a position too soon on just a tiny gain. Because everybody assumes that you've heard the old phrase, you can't go broke taking a profit, right? But if you take small profits and then you don't take your losses correctly and you take bigger losses, that's not the secret to success. So we've got to flip that around, take quicker losses, and then at least keep part of our position on when we're actually getting a nice score in our favor. Now, in this case, we would typically say if you allocated, say 10K to a system like this, or whatever your number would be, don't put in more than 5 to no more than 10% of the capital that you allocated to that service into any one new trade. So you might only be getting 500 to 1,000 bucks into the trade, but the point is that that's still going to allow you to participate without getting too heavy or too high on one recent run in the service. Because I find that sometimes people make the mistake after a good run of trades, they'll start piling on more and more money, and invariably you're going to get a trade that gets stopped. And so the point is that it's about being consistent. A lot of you are telling me when I ask my students and a lot of you, what is your main goal in your trading? And a lot are telling me, be more consistent. Well, money management and capital allocation is incredibly important to keep that consistency. And then we're going to give you nightly updates on every open trade that we have. So that way you'll know exactly what I'm thinking about the market, what I expect. And so from that perspective, you can say, okay, how do we take advantage of that situation here, okay? So and we're going to show you now some different chart examples here so you can really start to get some flavor about some of the things that I like to look for when I'm looking at these charts here. And then, of course, I do want to make you aware that usually you'd have to pay a couple grand to get a year of this service. But actually, I'm going to slice that down and actually allow you to get started with a 1-month trial for just 99 bucks on a special link that I've set up here for everybody today. And it's just a bigtrends.com/WOA. It's a different page than that one that you see at the bottom there. So this is a special link where you'll actually see a little bit later. I'll walk you through a little bit later how you can get started and try a month out for just $99, the cheapest I've ever allowed that service to be sold at for an introductory new subscriber. So the bottom line is, let me go ahead and share my screen right now. And I want to walk you through some chart examples. I'll come back to how you can get signed up a little bit later because I promised Fausto I wanted to educate you here for an hour and really focus you on some of my favorite option chart strategies here. So let me share my desktop. And let's see, monitor 1 here. So let's make sure this works. So, okay, sharing the desktop here. Let me know that you can see monitor 1 here just real quickly. If you want to type in the chat box here. Okay, great. Thanks, Wayne. I hate to go on if you can't see what I'm doing here. Let's look at the market first. It's been a really choppy environment in 2014, hasn't it? You see, we started the year and the S&P had this really nice run up here. We'd had some really nice %R buys, like the one in the fall where we broke out. That's classic %R breakout stuff here, and that was a really sweet spot area for us from mid-October really till early December. Why? Because you see the market breaking out October 16th. We're going over bottom that %R, and then it's that high is 172.6.16, and it closes 173.22. So that's telling you it's not stopping at that overbought level. The institutions who you and I know control the market are driving that thing forward. And so you can see, even though it even gapped up a little bit more the next morning, because we do all of our testing based on real world. If you had to get a signal to close, you couldn't buy it till the next morning's open. So that's how that's tested, and it's tested out really well. You can see We're above long-term moving averages, even still, even with the recent chop. Even with our acceleration bands, compare that to, and those are in purple against the Bollinger Bands in light blue. This is a very choppy trading range type of a market here. We got a little bounce today. But you can see right now percent R is not quite giving us what we want to see. It's showing us that we're kind of stuck up near the top end of the trading range, 188.40, 188.39, today's high, 188.04. You think the market's got a good memory? Yes, it does. It's looking backwards and saying, well, we haven't gotten through that 188.40 to 188.5 zone yet. We'll see what happens with, of course, earnings continue to roll out for names like Twitter and eBay here after hours. But the point I want to show you is it's not just what's going on in the daily chart. This is where we would work it down to the hourly chart. We tried to get a percent R. We did get a very light percent R buy, but the other confirming tools we look at on the hourly chart, like CCI, and then this directional movement lines with the green ADX heading lower means it's not really a good trend. It's a slow trend. Okay, but I want to show you some of the examples of trades that I have made of late for my weekly options accelerator clients, so you can get a little taste of what we've been doing in these current markets here. So, with weekly options accelerator, like one trade that I made here about a week ago, just to show you an example, would be Apache. We look at Apache here and you say, okay, back here last week, I put out a trade and I said, look, this is a pretty cheap option here. I said, let's buy to open this Apache April 25th, expired last Friday. And you see I was getting into it last Tuesday, a week ago today, 3:14 p.m. So we're getting in the final hour of trading, and we're buying that 85 strike call at $1.50 or better. And this is a service that if you're afraid of missing the trade, we have auto brokers like Thinkorswim and Trade Monster that can get you into that trade, and they'll tell us, okay, if we got filled, yes, we got filled. If it didn't get filled, they'll tell us that too. So it'll give us confirmation that, yes, we're into that trade for Apache. We're going to look at that chart here in a second. So we'll look at that option chart BC. So then we say is, okay, look, we're getting our target profits already reached that very next day. So we said sell half of the position at a 30% gain at $1.95. And so we're in there because we bought it just under $1.50. They're coming back. They first say working, and then they come back later and tell us that it was filled soon after that. And then we got our final target on the rest. Let's see, where was that? That's the 30% trade. We kept working that there that next morning, and there it is, filled on the first half. Okay, so we're filled on that trade, and then we're looking for usually a 50% gain or more on the rest. And we end up getting the rest very quickly there. You can see then this next one here. I remember we bought it around just $1.50, 225 is what we need to get 50%. And so we're saying sell to close, STC, sell to close the remainder of the position for a 50% gain on that portion. You say Apache, that's not a household name, right? But the point here is that if we look at Apache, remember just from this past week, I'll come in and I can't see your questions right now since I'm sharing my screen. I'll come back in and look at and answer some questions here in the final minutes before we're done. But, post them in there and we'll talk about it. So look at what's going on Apache back here. As you see, it's starting to break out. The daily chart's breaking out here officially that day that we're getting into it last Tuesday. It's buying the open there 85.38. And then we're also saying, look, it's already been on the buy on the hourly and then the 15-minute. It's coming off of a really nice kind of a early morning flush. I know you've seen that before where you get that early morning shot down and then boom, it shoots right back up. So when I see that flush, and we weren't in the trade yet, but we see that flush and we're saying, look, this thing's making new highs. It continues. It has a nice breakout here, and then it even has what we call a retest happening just after the noon hour. So this is doing exactly what we wanted to do, which is holding in the overbought territory. So you see what happened. We were putting out that trade to get a piece of this 85 strike call. Stock's about 86.25, and we're buying the options that are $1.25 in the money for $1.50. Okay, so now let's talk option charts because you can see what happens the next day as the stock races up. Remember, at 85 call, 87.5 is where we need 2.5. So literally in the first hour of the next morning, we're getting our 30 and then 50% profits. Let's look at that option chart, though. Hopefully, TradeStation still kept it here for me. You can pull option charts in a variety of different platforms. But just for example, please be there. Yes, it is. Good. Okay, so we don't have a ton of data you can see on that option chart for Apache because it doesn't trade every single, short-term interval, but what you do see is that it's rocketing above these acceleration bands, which are sitting down here at about $1. And then you also see that it's just continuing to trend up above a short-term moving average, the exponential average there in yellow. That's just a classic 10-bar exponential. And notice the hourly is doing the same thing. It's just kind of grinding higher. And even kind of right as we were buying into it here, as it was testing right back near the hourly moving average, just under $1.50. We bought it up to $1.50. And then the next day it's taking off there to over 2.5. Now, whatever happens from there is anybody's guess. Sometimes they'll go even higher, but I find that bulls and bears get rich, hogs tend to get slaughtered, right? You don't want to be piggish about it. You want to tend to focus on where you can take your profit targets and where you trail your stops. Part of what we always teach our subscribers is that we'll start off with an initial stop. And so, look, we got filled at $1.50. We know that a 30% loss is $1.05. So that next morning before the open, we're sending an alert out here that says, look, use a day-only stop at $1.05 on that position for starters. And then once we book that first profit, up 30%, you'll see us raise that $1.05 stop to our entry price of $1.50. So, from that perspective, and again, that option chart doesn't have a ton of data. And if I was really in a position where I needed to see an option that had even more data, you might look at the normal monthly May options, the monthly May 85s, which I actually did take a peek at in this case, because I was saying, it's not a lot of data we're getting at that trade, but even the monthlies look really powerful, not just on the %R staying overbought and trending, but also the CCI staying overbought. The DMI lines were positive. ADX was coming off a low level and just starting to trend actually that afternoon, right about the time we're putting out our trade. Now remember, we were buying the weeklies for $1.50. The monthlies were trading at 2.5. Now you still could have made good money that by that next morning, 2.5 went to 3.5 for about a 40% gain. So that wasn't bad either. But the weeklies gave us a little more leverage potential. Okay, so that's all just part of the equation. And if I were looking at that option right now, wouldn't be quite as interested, because you can see like this morning it tries to get back to overbought on the hourly chart on the little pop up, and then it doesn't follow through. It stops there. So that's resistance until it gets on through that high. So we look at not just the first overbought bar, but rather what happens after that. I call that trend confirmation. All right, so let's look at another example, because again, one trade doesn't make a system. You've got to follow a variety of different trades and realize that it's all part of a process of being more effective in your trading. Okay, so let's look at another recent example. How about Wynn Resorts? Okay, so let's look at the Wynn chart here first. Wynn Resorts, stock has been in a downtrend, right? And then this one's been both directions. It was in a monster uptrend late last year and early this year, right? And now it's been working all that off. We're back getting close to the long-term moving average. But the bottom line is that, we were getting a piece of Wynn back here in mid-April. The stock was, you saw a lot of support in the stock about 210. As you see it start to break right here, right on tax day, around April 15th, I said, you know what? This thing's breaking that morning. I said, I want to get a piece of that option. As the stock was breaking down to about 205, I said, buy the April options that are going to expire at the end of that week. Those are the April 19th expiration. Those are monthlies. They're trading like weeklies that last week of their life. And a $5 intrinsic, I'm saying buy it up to $6.90. So this one's got maybe a touch more time than usually I might prefer, but I really like the breakdown that we're picking up here. I'll show you why. It works just as well, sometimes even better on the put side, because as you know, put options, the stock can plunge a lot quicker than it can rally sometimes. So again, $5 intrinsic, we're paying $6.90 for it, right? So we're saying, look, think of it in those terms. $1.90 out of about $7 is almost 30%, not quite 30% time risk, versus about 70% intrinsic value. And so we put that out there for our subscribers to get a piece of that option. And let's go look at the intraday charts here too, and then we'll go look at the specific instructions. You see, there's the breakdown happening that morning. The hourly chart's breaking down under that first hour low here. And so you see it starting to break there. And look at that 15-minute chart. The bottom is falling out of that 15-minute chart. The daily chart's, it's on a sell signal, but it's above long-term support. So I wasn't expecting we'd probably go that much under $200 from 205. So I was a little bit wrong in the sense that it went a lot lower. it went to about 195, went an extra 5 points. So we left a little money on the table on that one, okay? Well, again, let's not be piggish. Let's be sensible about this. So what we said, we put that first order out. And so, we said, look, get in at 690, right? So then our auto brokers came back and said, okay, we got filled there at 690. And then an hour later in that case, we said, we're filled at 690. Now go ahead, cancel that stop, because a lot of people can't hold both a stop and a target at the same time. And so we say, okay, we'll briefly cancel that stop and go ahead and place the target. If we don't get filled quickly, we'll put the stop right back in. But we're moving up on our put option price, so that's helping us. We're going to look at that option chart's going to probably be gone here, but you get the idea here. April 210 put at 9 or better. At 9 or better, we're saying that's a 30% gain because we bought it at 690. So if it was 210 on $7, that'd be 30%. It's just a hair over 30% from 690 to $9. And then they confirm back and say, yes, we're filled at $9. Okay, and we're not done. Stocks continue to plunge here. So at about 201 is the intrinsic value right there, about an hour after we got filled, hour and a half maybe at maximum. We're getting filled there as it pops down to 201 here about 11:30 to noon. And then you say, okay, well then guess what? We're going to target a 50% gain on the rest if we can get it. And so we said, okay, look, our target on the remaining position is, where is that? I'm trying to find that one here. So with the rest of the position, we said, look, let's go ahead and get out of the rest of the trade here on that day, on the 15th. There it is. At you can do 50% on top of $7 would be 1050. So on top of 690, it was 1040 is a 50% gain or better on that position. And again, same concept. Is it sold them at 1040. So they booked it from Thinkorswim as well as Trade Monster from our recommended price there at 1040. So we get those confirmations from our brokers. That's what we use, for our official tracking of whether we got in or didn't get in for our subscribers. Most of the time we're getting into that. We're giving you a little bit of room to get in. We don't want to be too tight and then miss out on an opportunity. That's where a lot of traders get to be penny wise and pound foolish. Now you'll notice, while we won't have the April options chart on here because those disappear after a few days after expiration, you could look at the WIN May options chart, for example, on the 210 put in May, get a little taste of even that option. And so again, look at how beautiful this one's been, even in the last few sessions. If you were picking it up here as that May option starting to break out back here, again, it's a little too expensive for what we would buy because we buy them under, we get started under $10, under $1,000 a contract. This one was trading at about almost $15 or $1,500 a contract. But the pattern is still beautiful as it goes from 15 to 25, right? So you can see as it's breaking out on the 15-minute charts, breaking on the hourly chart, those things look encouraging if you were bearish on WIN in that window. Now you can see once it breaks, that low is the last low should have held, and once that breaks here, it's going to tell you should be out of that trade at about 18.5, and then now it's about 14.5, right? So you wouldn't be in that trade right now based on that type of an option chart. Let's look at an S&P option chart for a second, or even let's look at the NASDAQ for a second, because NASDAQ's been incredibly volatile lately. Then I'm going to come in and answer some questions here in just a minute. You're looking at the NASDAQ, and you see it's been an absolute pummeling. It doesn't look like it that much on the NASDAQ chart. It looks like kind of a normal correction back to the long-term support, also back to these recent lows from early February around on the QQQ, the NASDAQ 100, 83 1/3, and look, we tagged down 83.28. The market's got a really good memory, doesn't it? And then look where we bounced to. We bounced right back here to about 88.63 was a prior secondary high. And look at the high it made here about 4 days ago, 88.21. So, and that's a 50-day average overhead there. So, we're doing some battle here. We're going to have to get through that resistance before we get things going. The directional movement lines in that negative have been since this breakdown point under 88.82, right there, 88.22 a month ago, March 24th. It said net negative for a little while, and it has been, so even with the little bounce that we had, it was still saying that was just a key test, and that high held, and we slapped down some more. So if we were looking, for example, right now, the QQQs are at 87, and I was telling you, you know what? Let's just take a look for a second. If we were looking at the difference between the May 87, I wouldn't buy this option, but I do watch the at-the-money options very closely. And if I'm looking at the 87 put You can see it's edging down here, and it's really been getting pummeled today. Of course, the market's finally bounced a little bit today. And compare that to the 87 call. Does that mean the 87 call is going up? Well, it worked up a little bit today, but when you look at the hourly chart and the daily chart, these option charts do not support a buyer's market for QQQ options right now. Okay, they're saying it's more of a seller's market for that. That doesn't mean I'm going to immediately go out and go start selling credit spreads or iron condors or some wild and crazy strategy. But the point is that I'm just saying the wind's not at our back here to be buying these options for now. You know, it had one brief little window intraday here, and it failed by the end of the day. And frankly, I wouldn't have touched it because your hourly and your daily still look pretty poor. So when I factor those things in, I say stay away. And you get a lot of those situations where you just say, you know what, stay away. You know, for example, Netflix. Netflix is one everybody likes to talk about because it seems like, wow, the stock's making such huge moves here that anybody should be able to make money on Netflix, right? But look, like when it gapped up last week or a week and a half ago on its earnings, stock had been just under 350, 348.5 on April 21st, right before its expiration that came in there a couple days later here on the 24th. It gapped up, then it reversed back down, and right at the expiration finished about 5 points less than where the earnings were. Even on that initial gap, you made a little bit on the calls, but you lost even more on those weekly puts if you bought the straddle, which would be buying the call and buying the put. I won't ever buy the straddle, but I'll look at the pricing of the straddle to tell me how much the market's expecting that thing to move. And they were expecting a pretty big move, obviously, on Netflix, and they didn't get it. And so the straddle buyers got whacked on a situation like that. We stayed away from it because it just wasn't ideal. If you're looking at the intraday charts, now look, the daily's gone bearish. There's a little bear window here, and the 15-minute chart, a little bear window. But now we went through a little bounce today. So I'm stalking Netflix for a potential future bearish trade, but it's not anywhere close to that. You can see on the 15-minute chart here. So, you know, from this perspective, you're getting a sense about, you know, the kind of approach that I use here for my weekly options accelerator program. Now, before I answer a few questions before we're done, I want to remind you, where do you go to actually lock in this this super special value I'm telling you about? bigtrends.com/WOA, which is just short for Weekly Options Accelerator, WOA. That's the special page link we set up for you today. It's a little different than the one you saw on the slides because I wanted to give you not just the usual, you know, best price I give to my existing clients on the annual plus this, what we call our boot camp. I just recorded 3 live sessions. They're now available in our archives. So you can learn almost 5.5 to 6 hours of content I did just for subscribers. But if you just want to try out the trades, I'm giving you a special little link down below the Order Now button. If you want to try a month at a time on what we set it up as an auto renew, so if you don't like it over the first 30 days, just cancel and you won't pay anything else past your first $99 investment. The pressure's on me essentially at that point. So I'm saying, look, for $99 over the next month, I'll expect to get you out typically 6 to 8 trades per month. Over the course of a year, I promise my yearly subscribers 100 trades, but certainly in a month, 6 to 8 trades is a fair promise to say, look, you should see that value repaid many times over. If you don't, certainly I would expect that you're not going to continue. So I want to make sure you see great value in every trade that we do. Even if we get stopped out, you know why, what we did, how we get on board the next horse, and we move on. So what you do is you see that little highlighted and underlined text there on the 1-month special. You just left-click that. It will pop it into your shopping cart. And once you hit the checkout button in green there, it'll take you to a secure page that'll walk you through how that works. So it's for just $99, no taxes. If you're not in the state of Kentucky, you don't have to worry about that. No shipping charge. You get everything delivered to you via email and also via, you get a members access site so you can read about what I'm saying about my trades every single night. And then also you get the ability to get text alerts as well. And so my lead trade consultant, Chris, there standing by, he can answer any questions you might have if you call us at our 800 Big Trends line. So you see it takes you to the secure page here. You can see it's a great value. Usually my annual prices on these kind of products are around $2,000. But you can see, if you try it a month at a time for just $99, it's kind of my way of saying thanks to Fausto and all the good folks there at CyberTrader to say, look, we want to, you know, get you started and get you feeling really good about your investment, about the value that we offer you, not just in trades, but also in learning about how to trade weekly options well. So when you hit that button, you go on down, you see your key fields in bold you need to fill out. Pretty simple and explanatory. I don't need to explain to you how to fill out one of these, but just fill out the bold fields at least, and then basically get whichever credit card you want in there. And then if you've worked with one of our trade consultants, I know Chris has been on the call answering some questions, give them credit. If you're not, you don't have to, but I always like to give my consultants credit for helping our clients. And then bottom line is check on the terms and conditions box, which is actually all spelled out through this link here, as well as we also spell out all the terms, especially for a monthly auto renewal. I want you to read all about how we handle auto renewals. So basically, you know, you cancel before the 30 days are up, you're not going to get billed in the future. You know, that, and it's all very, very well spelled out there. Okay. So we're real clear, and I'm a big believer in total transparency, so you know exactly what we're looking at here. Okay, so you know, go to that page. It's bigtrends.com/WOA, and I think you'll really enjoy it. Obviously, those who take advantage of the yearly special are not only saving some money on the year, but you're going to also, yearly folks will get the 3 weekly options boot camp sessions. Like I said, almost 6 hours worth of training that I did on weekly options and a lot of different strategies, including earning strategies like calendars and other things too, not just the weekly options accelerator techniques, but a lot more weekly options strategies in the boot camp for annual subscribers. But again, if you're new to us, I expect you're probably going to want to try us out first. That totally understand. Just click on that link. If you want the full year, hit the yellow order now button, and the full year will lock in the extra bonus of the weekly options bootcamp videos for 12-month subscribers. Make sure whichever one you don't want, make sure to exit out. So if you're new, I'm expecting you'll just probably want to go month to month. No worries. We're pretty low-key at Big Trends. We'd like to make sure you're a happy client over time. And the big thing I would say is just make sure you start small, okay? So don't try to get too aggressive. Make sure that you basically start small and build from there. And we're all about making sure that we'll help you with that. Now, a couple questions that came in here. I came back here to look at it. And like I said, usually 12 months would be $19.97. You're locking it in today for just $99 a month. That's a super value to lock it down at that site link. I'll put it up one more time, bigtrends.com/WOA. Okay, so that's the special link with the monthly price on there that you won't find on the other link. Okay, now Salim asks, do we close all these types of trades prior to the expiration? Absolutely. You're not going to acquire any stocks. I'm a big believer in, you know, we're either right or we're not. We capture the opportunity when we're right, we stop it out if we're not, and we move on. So we're always tightening those stops too. So we're not going to stay at minus 30. We'll move it up to break even fairly quickly after that situation. Now, Doug asked about what's our win ratio on these types of trades. And it's a good question because, look, if you're using stops, you know, you're going to get some that stop you out for sometimes even break even. Like we might make a little money in the first half, stop out of break even, sometimes even, you know, if it gaps against us at a slight loss. So, you know, typically we won't expect that we have to win a high win percentage as long as we can make sure that we keep our losses small and we can make bigger money when we're right. So, you know, as I said before, my goal is to do about 2-to-1 reward for our risk. If we can do even 1.5 times the gain relative to the loss, you don't even have to have a 50% win percentage to still make good money buying weekly options. So that gets you over this desire that most people have to be right 90% of the time. You know, the reality is that those strategies that do allow you the ability to be right a high majority of the time usually also involve big risk when you're wrong. We want to control that risk and make sure you don't have to take big risks that way. So we'll really help you with that. Let's see, last couple of questions, and then we'll wrap it up here. Let's see, going back through. These are straight buys. That's correct. We're not doing anything to sell options here. We're just doing straight buys. And then, you know, as far as can this be auto-traded? Yes. Well, several brokers can automatically get you in and out of these trades. You don't have to lift a finger. So if you're interested in learning more about that, call us at 1-800-BIG-TRENDS. So an easy one to remember, right? Because we are bigtrends.com, but it's 800-244-8736. And my lead trade consultant, Chris, can help you, walk you through how to get set up with any questions you have. Or you can also email him at chris@bigtrends.com. So he'll stand by to help you get set up. Chris is great at really help. I do the analysis along with a couple other support analysts that help me to fire out the trades. I make every trading decision as it relates to what the system is saying from looking at it for 25 years, you deserve to have my eyes on it. And the bottom line is they help me to send the emails out and do some of that busy work, so we make sure to get the emails as well as the text alerts out to you instantaneously as soon as I say, okay, go, then it goes out to everybody at the same time. It's just that the auto trading can help you to make sure that you can really take good advantage of that. Doug asked, if you have a 50% win ratio, 2-to-1 win to loss, what would a 10K account grow to? I mean, you can run the math there. If you're saying, say you're putting in, say, no more than 10% of the capital into any one trade, Doug, you'd be talking about $1,000 a trade. And you're saying, okay, if we're averaging, say, a 40% gain against a 20% loss, you might be knocking out on average over the couple of trades, a couple $100 over a couple trades, and then you're saying, okay, then do that many times over the course of the year, and that's where the profit starts to add up. So, from that perspective, and that's what I'm also saying is that for $99 a month, you can see that even over a couple of trades, even with a decent winner and a controlled loser, you're still going to be paying for the service and have plenty left over for yourself as well. So, that's why, we're big on showing you great value. I know Fausto does as well. So we wanted to make sure that you could see tremendous value from this package. Appreciate all the great questions. I know I don't want to keep Fausto and his team here all night, so I'm going to go ahead and wrap it up and say thanks so much for being with us. If you have any questions, call us at 800-BIG-TRENDS or go to that site that we set up for you. It's different than the one that's on the slide, so make a note of that. It's bigtrends.com/WOA is the one that has the text on the bottom for the $99 for the 1 month. Check it out. If you have any questions, call us at 800-BIG-TRENDS. And thanks so much for being with us. I'm going to hand it back over to the good folks at Cyber Trading U so they can wrap it up here and close down the room. Take care, trade them well, and we'll see you again real soon.